All right, welcome back. So we're doing a deep dive into stock-related agreements for members of the founding team and what they should and shouldn't look like. So first and foremost on everyone's mind is always vesting. We've done a series of videos on the topic of vesting and what it means in a stock grant related context versus an option grant. And if you want to know more about the tax impacts and how vesting works, I'll refer you to those. But what should vesting look like in these agreements? Well, the standard used to be what's called a 4-year vesting term with a 1-year cliff. So after 1 year, 25% of the shares subject to the grant agreement would be fully vested, meaning that the company can't repurchase those shares anymore if the person leaves the employ or the service of the company. And then the remaining 75% would vest over 3 years. The next question was, would there be automatic acceleration of vesting? And often, in many cases, there was what's called double trigger acceleration clauses. So somebody would be fully released from all of their vesting provisions in their stock grant agreement if two things occurred. Number one, a change of control or an exit, and number two, that person was let go within some period of time, or they left for good reason within some period of time, usually a year after the change of control. So those are called double trigger acceleration of vesting provisions. These days, I find that most angel investors and venture capital investors are a little bit more lenient in how they allow founders to set up vesting. I see everything from 2-year vesting schedules to 3-year vesting schedules. However, invariably, in those cases of 2 and 3 year, those companies are well beyond what I would consider a pre-seed or seed stage, and they're generating upwards of $1 million in revenue. Oftentimes, the founders have put their own capital at risk in the company to a pretty substantial degree before they're even raising funds. And I would say that it's not necessarily the norm. I think that most investors still do want to see 4-year vesting schedules in place. They are usually comfortable with giving some credit for time served, so to speak, so the time you spent in your company prior to them coming in. Although it's not totally out of the realm of imagination that an investor will want you vested from 4 years from the date of their investment. And that used to be what everybody gave, but the market has definitely changed in that regard, and I think it's much more negotiable. If you have more questions about vesting, hit us up, let us know. I'm sure we can answer those questions.